Have you ever looked at the stock market and felt like, well, it's speaking a completely different language? Or maybe wondered about the secret sauce behind long-term financial growth? What if there was a way to truly understand it, quickly and deeply without getting lost in a jungle of jargon? Today, we're embarking on a pretty crucial deep dive into the very bedrock of stock markets. Our mission is to take a whole stack of essential insights, things like the fundamental human need to invest, how companies actually go public, what really makes a stock price tick, and distill the most important knowledge for you. We'll be focusing mainly on the Indian market as our reference point, using its examples and rules to explain these concepts.
Yeah, and we'll uncover not just the mechanics, but the sort of deeper why behind investing, explaining why it's often more than just a choice for many people, but, well, a powerful necessity. We're going to try and demystify this whole complex ecosystem, cut through the noise, and give you some real clarity. Those insights that make complex financial ideas just click.
All right, let's jump straight in then. Why invest? And maybe even more importantly, what happens if you don't? Okay, picture this. You earn, say, 50,000 rupees a month. You spend 30,000 and you diligently save 20,000.
Now, it's pretty good so far.
Right. Now, imagine your salary grows 10% a year, but living costs also rise by 8% each year, over 20 years. If you just keep that extra cash sitting idle, maybe under the mattress or in a basic savings account, you'd end up with roughly 1.7 crores.
It sounds like a lot of money.
It does. But here's the real eye-opener.
Yeah.
After retirement, that's only enough to cover about 8 years of your expenses.
Wow, only 8 years. And that stark reality, it really highlights a fundamental challenge for, well, everyone. How do you make sure your money lasts, not just for a few years, but for your entire post-retirement life? And this brings us straight to the first and maybe the most compelling reason to invest: fighting inflation. That constant creeping rise in the cost of living just relentlessly eats away at your purchasing power. Your idle cash literally buys less over time.
Exactly. And what if you did invest that surplus cash, let's say at a kind of conservative 12% per year return? Our research shows your balance could skyrocket to a staggering 4.26 crores.
Wow.
That's more than double, 2.4 times the amount compared to just letting it sit there. That's the power we're talking about.
Absolutely. And beyond just beating inflation, strategic investing, it really empowers you to actively build wealth, to achieve those big life goals. Children's education, a wedding, buying that dream home.
Post-retirement holidays.
Yes, enjoying retirement. These things become much more attainable. This isn't just numbers on a page. It's a really powerful illustration of compounding, where your earnings start earning for you, multiplying your wealth over time. If you have the patience, of course.
Okay, so you're convinced investing is crucial, but where do you actually put your money? What options are out there, and what returns can you realistically expect?
It really starts with choosing an asset class that fits your personal risk tolerance and what you expect in return. Broadly speaking, you've got a few main options. First, fixed income instruments. Think of these as lending your money out. Things like bank fixed deposits, government bonds, corporate bonds. Historically, in India, these have offered returns maybe 8 to 11%, with very little risk to your initial investment.
Sounds safe.
It is relatively safe, but here's the catch. They often struggle to beat inflation, meaning your real purchasing power might still go down. Then there's equity. This means buying shares, literally small pieces, of publicly listed companies on exchanges like the BSE, the Bombay Stock Exchange, or the NSE, the National Stock Exchange. Now, there's no capital guarantee here. Prices can definitely go down.
Right, that's the risk.
But historically, Indian equities have generated pretty attractive returns. We're talking around 14–15% compound annual growth rate, CAGR, over the last 15 years or so. And some really well-run Indian companies have delivered over 20% CAGR long-term. Plus, a really significant bonus, particularly in India. Long-term capital gains from equities are completely tax-exempt.
That's huge. And just to underline that equity potential, our data shows investing that same surplus cash at an average 15% return. It could have grown your pot to an amazing 5.4 crores in 20 years.
Massive difference.
Yeah. Compare that to 3.3 crores from fixed income at 9%, or maybe 3.09 crores from gold or silver bullion at 8%. It's really striking.
Then you've also got real estate. Buying and selling properties, sites, apartments, commercial buildings. This offers potential rental income and capital appreciation.
True, but it needs a lot of upfront cash, right?
Exactly. Large cash outlays typically, and transactions are more complex, less liquid, harder to buy or sell quickly compared to stocks.
Yeah.
And finally, commodities like bullion, gold, and silver, often seen as a safe haven, especially when the economy looks shaky. They've yielded around 8% CAGR over the last couple of decades.
So with all these options, what's the practical takeaway for you, the listener?
Well, the optimal approach usually involves a mix, a blend of these different asset classes. It's a strategy called asset allocation. Basically, don't put all your eggs in one basket. Diversify your risk.
Makes sense. Can you give an example?
Sure. So a young professional, maybe in their 20s or 30s, they generally have a higher risk tolerance, a longer time horizon. They might prudently put, say, 70% of their investable money in equity, maybe 20% in precious metals like gold, and the rest 10% in fixed income.
Okay. And someone older.
Right. Contrast that with a retired person.
Yeah.
Lower risk appetite, needing more stable income. They might flip that completely, perhaps 80% in fixed income and only 10% each in equities and precious metals. The key point is that specific ratio. It always depends on your individual risk appetite and your financial goals.
Right. So now you're thinking about equities. The next logical question is, how do you actually do it? How do you buy a share? And what exactly is a stock market beyond, a fancy building or a website?
Well, at its core, the stock market is just an electronic marketplace. Think of it less like some mysterious beast and more like a highly organized supermarket. But instead of groceries, it's purely for buying and selling shares.
Okay.
Its main purpose is just to facilitate those transactions, efficiently connecting buyers with sellers. But here's a crucial point. You can't just walk in directly. You access this market electronically through a registered intermediary, a stockbroker.
And in India, we mainly use two major stock exchanges, right? The BSE Bombay Stock Exchange and the NSE National Stock Exchange.
That's correct.
But once you're sort of in the market via your broker, who else is playing this game? Who are the participants?
Oh, it's a really diverse crowd. You have domestic retail participants, that's people like you and me. Then there are NRIs, non-resident Indians investing back home. You've got huge domestic institutions. Think of giants like the Life Insurance Corporation of India, LIC.
Okay, big players.
Very big. Plus, domestic asset management companies, AMCs, these are the mutual fund companies, and then really powerful foreign institutional investors, or FIIs. These can be large foreign asset managers, global hedge funds.
So a real mix, retail, institutional, domestic, foreign.
Exactly. But regardless of who they are, everyone shares one basic goal: to make profitable trades. Or, maybe more bluntly, to make money.
Right. And this is where it gets, really interesting. Because whenever you have significant money involved, human emotions, especially greed and fear, they tend to run incredibly high.
Absolutely.
And that can easily lead to unfair practices. India's seen this happen, unfortunately, with things like the Harshad Mehta scam in the past. So with all that money and emotion swirling around, who's the referee? Who makes sure it's a level playing field?
That's a vital question. In India, that crucial role belongs to the Securities and Exchange Board of India. Everyone just calls it SEBI.
SEBI, okay.
SEBI's job is pretty broad. Foster the development of the stock exchanges, rigorously protect the interests of us retail investors, regulate all the market participants and intermediaries, and generally ensure the markets are fair and transparent for everyone.
So SEBI oversees a lot of different entities involved in the market.
A huge number. They set the legal framework, they oversee credit rating agencies like CRISIL, debenture trustees, and critically for you as an investor, the depositories. Companies like NSDL and CDSL.
NSDL and CDSL, what do they do exactly?
Think of them like secure digital vaults for your shares. Your shares are held electronically in what's called a demat account, and these depositories manage that system.
Ah, okay, so my shares aren't physical certificates anymore.
Nope, mostly all electronic now in your demat account. SEBI also regulates the depository participants, or DPs, usually your broker, who help you open and manage that demat account. They regulate merchant bankers, who help companies raise money, and of course your stockbrokers, your direct gateway to the market. It's a whole ecosystem designed to keep things in check.
Got it. A comprehensive system. Okay, let's shift gears a bit to something really fascinating. A company's journey. From just an idea all the way to becoming publicly traded. Understanding this helps make sense of the IPO market, right? Where companies first sell shares to the public.
Absolutely central. Imagine a budding entrepreneur, right? Brilliant idea, maybe. Sustainable organic cotton t-shirts. Super fashionable.
Okay, I like it.
In the very beginning, the pre-revenue stage, they're probably not going to attract big institutional money. So where do they go first? Usually family and friends.
The FFF round.
Exactly. These early backers, they're called angel investors. They take the biggest risk, making a kind of blind bet on the entrepreneur's vision. The money they put in, that's the seed fund, just to get things started.
And here's where the story can get really exciting. Once that t-shirt business actually starts making money, breaking even, generating revenue, its position totally changes. Now it can attract venture capitalists, VCs for what's called Series A funding.
Right, the first institutional round.
Yeah. And our case studies show a company's valuation can just explode here. Maybe jump 10 times from, say, 5 crores initially to 50 crores. Just by proving the business model works and getting that VC stamp of approval, that's where serious wealth creation often kicks off.
It really is. And as a company keeps growing, needs more money for serious expansion, what we call capital expenditure or CapEx. It might seek more funding, maybe Series B from VCs or Series C from private equity, PE investors.
Okay, so PE firms come in a bit later than VCs.
Generally, yes. PE firms usually invest larger amounts at a slightly more mature stage. They often take a more hands-on role, too, maybe putting their own people on the company's board to help steer things strategically. Risk-wise, PEs tend to have a slightly lower risk appetite than the VCs or those initial angels.
Okay, so fast forward. Our t-shirt company is now a huge success. Maybe they want to go international, need a massive CapEx injection, say 200 crores.
Big money now.
Yeah. This is often the point where they decide to go for an initial public offer, an IPO.
Exactly. And this brings up a really important question. Why do companies even bother going public? What's in it for them?
Your question.
Well, the reasons are pretty compelling. First, it's about raising a lot of money for that expansion, that CapEx, without taking on debt. No debt means no interest payments, which boosts profitability.
Makes sense. What else?
Second, it spreads the business risk. Instead of just a few owners, you have thousands, maybe millions of public shareholders. Third, it provides that crucial exit strategy for the early investors, the angels, VCs, PEs. They can finally sell their shares and realize their profits.
Payday for them.
Pretty much. Fourth, it lets the company reward employees with employee stock options, ESOPs, so staff can benefit from the company's growth too. And finally, just becoming a publicly listed company hugely boosts visibility, credibility, status. It's a big deal.
So how does knowing this help you, the listener, when you see an IPO announcement?
Well, it means an IPO isn't just some random fundraising event. It's often the culmination of a long journey, ideally validated by those earlier funding rounds from smart VCs and PEs. That history can be a good sign that it's a potentially well-run company.
Okay. And the IPO process itself, I assume SEBI regulates that heavily?
Extremely heavily. It involves appointing merchant bankers. They're also called book-running lead managers, or BRLMs. These bankers do tons of due diligence, checking everything. They prepare the draft red herring prospectus, the DRHP.
That sounds important.
It is. The DRHP is the key document. If you're thinking of investing in an IPO, you absolutely need to read the DRHP. It has all the details about the company, the risks, everything.
Okay, note to self, read the DRHP.
Definitely. The bankers also help set the price band, the range for the share price, and they run road shows to promote the IPO to potential investors.
So what's the typical sequence? How does it unfold?
Okay, generally. Appoint the merchant banker, apply to SEBI, get SEBI's approval, prepare that detailed DRHP, then market the IPO, fix the price band, and finally, the book building process starts.
Book building, what's that?
That's when the public institutions and retail investors like you can bid for shares, indicating how many shares they want and at what price within the band. This demand helps determine the final cutoff price at which the shares are actually allotted and listed.
Got it. And then it lists on the exchange.
Exactly. And that's a key transition point. The primary market is only that initial IPO bidding process. The second the stock starts trading publicly on the BSE or NSE, it's now in the secondary market.
Primary market, IPO, secondary market, everyday trading. Okay. So once a stock is in that secondary market, trading daily, what's really going on? What makes the price move?
Well, the stock market is still that electronic marketplace where buyers meet sellers. But what's fascinating is they're essentially trading different opinions, different points of view. If you think a stock's going down, you sell. If you think it's going up, you buy. As the old saying goes, different opinions make a market.
So the exchange just matches these buyers and sellers?
Pretty much. The exchange's main job is to ensure those orders get matched efficiently and the trades get executed smoothly.
Okay, but what really causes those price swings we see every day?
Often, it's news and events. They can be huge drivers. Take a company like Infosys. A really positive announcement from management. That can spark a rally. Buyers might suddenly be willing to pay almost any price. Conversely, maybe a negative statement comes out from an industry body like NASSCOM, say, about declining IT budgets. That could trigger immediate selling pressure. pushing the stock price lower. It shows how fast the market reacts to new information.
So news is a big factor. What else?
Just basic demand and supply imbalances, even without specific news. A huge, heavily traded company like Reliance Industries, its price will constantly wiggle around just due to the sheer volume of buying and selling interest.
Right. Always activity there.
Yeah, but a smaller, less-known company, its price might stay flat for days if there's no news and no significant change in who wants to buy or sell it.
Okay, so let's say I've decided I want to buy some shares of Reliance. How does that actually work? What buttons do I press?
Okay, you log into your trading account, the one your stockbroker provides. You place an order.
Yeah.
Buy X shares of Reliance at Y price. Before sending it to the exchange, your broker checks. Do you have enough money in your account?
Right. Gotta have the funds.
Yep. Once confirmed, the order goes to the exchange. Its matching system instantly looks for a seller or sellers willing to sell at your price. Once a match is found, boom, trade executed. The shares are then electronically earmarked to be credited to your demat account, and the money is earmarked to be debited from your trading account. Same happens in reverse for the seller.
It sounds seamless, almost instant. But you mentioned earlier ownership isn't quite instant.
That's right. There's a settlement cycle.
Yeah.
If you buy shares on T-Day, the trade day, you'll actually see those shares appear in your demat account by the end of T+2 day. That's 2 business days later.
T+2. Okay.
Similarly, if you sell shares, the funds from that sale will be credited to your trading account also on T+2 day.
So what about those people who buy today, sell tomorrow? BTST. How does that work if the shares aren't technically yours yet?
Good question. BTST does let you sell the stock the day after you bought it. But you're right, the stock isn't actually in your demat account yet. You're selling something you've contracted to receive, but haven't yet. This involves a specific type of risk. What if the original seller defaults, for instance? It's a bit more complex. So for new market participants, it's probably wise to avoid BTST trades until you really understand those risks involved.
Okay, good advice. So once the shares finally land in my demat account on T+2, I'm officially a part owner of the company.
Yes. Proportional to how many shares you hold, of course. You're a shareholder. And with that ownership come certain corporate benefits.
Like what?
Things like dividends, if the company pays them, stock splits, bonus shares, rights issues. And you get voting rights on company matters.
And how long do I have to hold the stock?
The holding period. It can be incredibly short. Traders might hold for just minutes or hours, or it could be, well, forever. As Warren Buffett famously said when asked about his favorite holding period, it completely depends on your strategy.
Right. Trader versus investor again.
Exactly. But ultimately, whether you're trading or investing, success often comes down to one thing: generating a reasonable rate of return on your money.
How do we measure that return properly?
Okay, there are 2 main ways. First, absolute return. This is straightforward. Used for holding periods of 1 year or less. It just tells you the simple percentage gain or loss. Example, buy Infosys at 30 rupees, sell at 35.50. That's a 17.16% absolute return. Easy?
Okay, what's the other way?
The second, and often more important for comparison, is the compounded annual growth rate, or KGR. You use KGR when comparing returns over multiple years because it accounts for the effect of time and compounding.
How does that change things?
Well, take that Infosys trade. 17.16% absolute return sounds good. But what if it took you 2 years to achieve that? The KGR would actually be only 8.2% per year. Suddenly, it doesn't look quite as impressive compared to, say, a fixed deposit maybe offering 9% at the time.
I see. So annualizing it gives a much better comparison.
Precisely. Always try to express returns on an annualized basis using KGR for periods over a year for accurate comparisons.
Okay, so thinking about holding periods and returns, where do you fit in? Are you more of a trader or an investor? Let's define those.
Right. Traders typically have a short-term view. They're looking for quick opportunities, aiming to get in and out profitably as soon as possible, constantly evaluating risk versus reward for the next trade. There are different styles. A day trader opens and closes all their positions within the same day. No overnight risk.
Sounds intense.
It can be. Then there are scalpers. They're a type of day trader who deals in huge volumes, trying to capture tiny price movements for quick, small profits, in and out in seconds or minutes.
Wow.
And then swing traders. They hold positions a bit longer, maybe a few days to a few weeks. They're generally more willing to take on overnight risk to capture a larger price swing. Famous traders often cited include George Soros, Ed Seykota, known for their shorter-term, often bold, market calls.
Okay, so that's trading. What about investors?
Investors are different. They buy a stock expecting significant long-term appreciation. Their typical holding period is measured in years, sometimes many years. They generally fall into two popular camps. Growth investors. They're looking for companies poised for significant growth due to big trends, maybe new technology, changing demographics. Think of buying Infosys way back in the 90s, anticipating the whole IT revolution.
Got it. Betting on the future.
Exactly. And then you have value investors. They hunt for fundamentally good companies that are currently out of favor, beaten down by the market for maybe short-term reasons. They believe the stock is trading for less than its intrinsic worth, making it a great value buy, like maybe buying L&T in 2013 when it was considered undervalued.
Looking for bargains in good companies.
Precisely. Famous investors often mentioned are Warren Buffett, Peter Lynch, known for their long-term focus.
What's really fascinating here is that both approaches trading and investing can work, right? Despite being so different.
Absolutely. Different styles, different time frames, different risk levels, but both can lead to success if done well and consistently. It's about finding what suits you.
Okay. Now, if I wanted a quick snapshot of the whole market right now, is it up, down, sideways? How could I possibly know? I mean, you can't check all 5,000 stocks on the BSE or 2,000 on the NSE one by one.
No, luckily you don't have to. It's like checking city traffic. You don't look at every single car. You look at key roads or maybe a traffic map. In the stock market, we use a market index.
Ah, the Sensex and the Nifty.
Exactly. The S&P BSE Sensex for the BSE and the Nifty 50 for the NSE. Think of them as prepackaged indicators, giving you a minute-by-minute reading of the overall market sentiment, how participants collectively feel about the future.
So if the Nifty is up 100 points, that means people are generally feeling optimistic.
Generally, yes. An upward move suggests optimism about the future. If the index drops, it signals pessimism is taking hold. It's a mood barometer.
What are the practical uses of an index, beyond just telling us the mood?
Oh, they're incredibly useful in several ways. Information, as we said, general market trend, even a rough proxy for the country's economic health. Benchmarking this is crucial. How did your portfolio do compared to the Nifty? The goal for most active managers is to beat the index.
Right, the benchmark.
Trading sophisticated traders often trade the index itself, maybe taking a broad bet on the economy using index futures or options in the derivative segment. And portfolio hedging long-term investors can use index derivatives to protect their stock portfolio against potential market downturns.
Okay, that's quite versatile. And how do they decide which stocks go into the index, like the Nifty 50?
The exchanges assign weightages based on something called free float market capitalization.
Free float market cap. What's that?
Basically, it's the value of shares that are readily available for public trading, multiplied by the stock price. It excludes shares held by promoters or governments that aren't typically traded.
Okay, so a bigger company with more publicly available shares has more weight.
Exactly. That means a stock like ITC, which historically have had a high weightage in the Nifty 50, will have a much bigger impact on the index's movement than a stock with the lowest weightage, like DLF might have had at times.
Got it. And there are sector indices too, right? Like for banks.
Yes, absolutely. Sector-specific indices like the Bank Nifty or the CNX IT Index give you a focused view on the sentiment within just that particular industry. Very useful.
Okay, let's quickly run through some common market slang or terminology, the language you hear bandied about.
Good idea. The jargon. So a bull market, or being bullish, simple. You believe stock prices are likely to go up. You're optimistic.
And the opposite.
A bear market, or being bearish, you believe prices are likely to go down. You're pessimistic.
Bull up, bear down. Got it. What about trend?
Trend just refers to the general market direction. Is it bullish, up, bearish, down, or maybe sideways, kind of flat, choppy, no clear direction? Face value or par value, that's the nominal value printed on a share certificate, often a small number like 1, 2, 5, or 10 rupees. It's mainly important for calculating things like dividends or stock splits.
Okay.
You'll also hear 52-week high-low and all-time high-low. That's simply the highest and lowest price a stock has traded at in the last year or in its entire history on the exchange. Gives you context for the current price.
Right. Now here's one that trips people up. Long position versus short position. Let's start with long.
Okay. Going long or having a long position is the standard way. You buy shares or intend to buy them because you expect the price to rise. You are bullish, buy low, sell high.
Simple enough. But what if you're bearish? What if you think a stock is going down? Can you actually profit from that?
Yes, you absolutely can. This is through shorting or taking a short position.
Okay, explain this carefully. How do you sell something you don't own?
Sounds weird, right? Let's use that classic analogy. Imagine I promised to sell you a brand new smartphone today for 16,500 rupees, even though I don't have it in my hand.
Okay. Risky for you.
Maybe. My plan is I believe the price will drop. So later today, I go to the market, buy that same phone for only 14,000 rupees, and then deliver it to you as promised.
Ah, and you pocket the 2,500 rupee difference.
Exactly. I sold first at the higher price, then bought later at the lower price. That's the essence of a short trade.
So how does that work with stocks? Do I borrow them?
Precisely. When you short a stock in the market, the system facilitates borrowing those shares, usually from another broker or institution. You immediately sell those borrowed shares at the current market price. Then you wait. If your bearish view is right and the price drops, you buy back the same number of shares at the lower price. Those shares are then returned to the lender, and you keep the difference minus fees as your profit. Square off. That just means closing your open position. If you were long, bought shares, squaring off means selling them. If you were short, sold borrowed shares, squaring off means buying them back. Intraday position. A trade you open and close within the same trading day. OHLC stands for open, high, low, and close. These are the 4 key prices for a stock during a specific period, usually a day. You see them on charts all the time. And volume represents the total number of shares traded, both buys and sells counted, for a stock on a given day. High volume usually means high interest or activity.
Okay. And you mentioned market segments earlier.
Right. Just briefly, the market has different sections. The capital market is where you trade regular equity shares, preference shares, ETFs, etc. The futures and options segment, or equity derivatives, is where you trade leveraged products based on stocks or indices more complex, higher risk-reward. And the wholesale debt market deals with fixed income things like government bonds and corporate bonds, usually traded in large institutional lots.
Got it. So while we're all busy trading in these segments, there's a whole background process making sure everything works right, the clearing and settlement.
Absolutely. It's the crucial, often invisible plumbing of the market. This clearing and settlement process is mainly handled by professional bodies like NSECL for NSE trades and ICCL for BSE trades. As we mentioned with T+2, when you buy a stock on trade day, T-Day, the money leaves your account. But the shares are only officially debited from the seller and credited to your DMAT account by the end of T+2 day, 2 business days later.
And same for selling. Shares blocked, cash comes T+2?
Exactly. Shares are blocked from your DMAT immediately when you sell, but the cash proceeds hit your trading account on T+2 day. This structured delay ensures everything matches up and risk is managed.
Okay. And my broker sends me some kind of confirmation.
Yes, you'll get a contract note. Think of it like a detailed invoice or bill for your trades that day. It summarizes all your buy-sell transactions, the prices, quantities, and very importantly, all the charges. Brokerage, taxes, exchange fees, etc. You should always check it.
Good to know. Now let's talk about what companies themselves do after they're listed, these corporate actions you mentioned.
Right. These are initiatives taken by the company's board, usually needing shareholder approval, that directly affect the stock or shareholders. Understanding them gives you real clues about the company's health and strategy.
Okay, like what? Dividends?
Dividends are a common one. These are payments usually from profits made by the company to its shareholders on a per-share basis. They're often quoted as a percentage of the face value. So if Infosys, with a 5 rupee face value, declares a 42 rupee dividend, that's technically an 840% dividend. Looks huge, but it's 42 rupees per share you own.
Do companies have to pay dividends?
Nope, not mandatory. They might decide to reinvest all profits back into the business for growth, or maybe pay from cash reserves, even if they didn't make a profit that year. To get the dividend, the key date is the ex-dividend date. You must own the shares before this date. It's usually 2 business days before the record date when the company checks its records.
And the stock price usually drops on the X date?
Typically, yes, by roughly the amount of the dividend per share, because that cash is now leaving the company to go to shareholders.
Makes sense. What about bonus issues and stock splits? They sound similar.
They are similar in effect. A bonus issue is like a stock dividend. The company gives existing shareholders extra shares for free, issued from its reserves. It's done in ratios, like 2.1 means you get 2 new shares for every 1 you hold.
So I have more shares. Am I richer?
Not immediately. While your number of shares triples in a 2.1 bonus, the price per share will adjust downwards proportionally. So the total value of your investment stays the same. The company's market cap doesn't change.
So why do it?
Often to make the share price seem more affordable, especially if it's become very high. Encourages more retail investors to buy in. Increases liquidity. A stock split achieves a very similar outcome. More shares, lower price per share, same total value. But it's done by changing the face value. For example, a stock with a 10 rupee face value splits 1.1. The face value becomes 5 rupees. For every one share you held, you now have two, but each is worth half as much. Again, aimed at increasing liquidity and accessibility.
Okay, bonus and split. More shares, lower price, same value. What's a rights issue?
A rights issue is different. This is how a company can raise fresh capital, new money, but instead of going to the whole public again, they go only to their existing shareholders first.
Like a special offer for current owners.
Exactly. It's like a second IPO, but just for the existing shareholder family. You get the right to subscribe to new shares, usually at a discount to the current market price, in proportion to your holding. E.g., a 1.4 rights issue means you can buy one new share for every four you already own.
Should I always take up the rights offer?
Not necessarily. You need to be convinced about why the company needs the money and its future prospects. And crucially, if the market price drops below the rights issue offer price, it's obviously cheaper just to buy more shares in the open market.
Good point. Okay, one more. Buyback of shares.
A buyback is when the company uses its own cash to buy its own shares back from the open market.
The company buying itself. Why?
Several reasons. It reduces the number of outstanding shares, which can boost earnings per share, EPS. Promoters might want to increase their stake. It can help fend off hostile takeovers. It can also signal management's confidence that the shares are undervalued, or just provide support to the share price if it's been falling. Generally, a buyback announcement is seen positively by the market.
Okay, that covers corporate actions, but what about bigger picture stuff? The whole economy, how does that affect stocks?
Hugely. Beyond company specifics, these broader economic and even non-economic events constantly sway the markets. You need to be aware of them.
Like interest rates.
Definitely. One of the biggest influences in India is the monetary policy set by the Reserve Bank of India, the RBI, India's central bank. The RBI controls money supply mainly by adjusting key interest rates. The repo rate, RBI lending rate to banks, the reverse repo rate, RBI borrowing rate from banks, and the cash reserve ratio, CRR, the funds banks must keep with RBI.
And they're always trying to balance growth and inflation, right?
Exactly. It's a constant tightrope walk. High interest rates can cool down inflation but might slow economic growth by making borrowing expensive. Low rates can stimulate growth but risk pushing inflation higher. Markets hang on every word from the RBI's quarterly policy reviews, especially interest rate-sensitive sectors like banks, autos, real estate.
And inflation itself, how do we track that?
Inflation, that sustained rise in general prices, eroding your money's value, is critical. High inflation is usually bad news for markets. We track it mainly with two indices in India: the Wholesale Price Index, WPI, for wholesale prices, and more importantly, the Consumer Price Index, CPI, for retail prices, which reflects the cost of living for you and me. The Ministry of Statistics, MOSPI, releases CPI data monthly.
What other big economic numbers should we watch?
Keep an eye on the Index of Industrial Production, or IIP, also from OMOSPI, monthly. It shows how the industrial sector is doing. Rising IIP is generally good. Also, the Purchasing Managers Index, PMI. This is a survey-based indicator for manufacturing and services activity. A reading over 50 suggests expansion. Below 50 suggests contraction. Gives a forward look.
And the annual budget, that always seems to move markets.
Oh, absolutely. The union budget, usually late February. The finance minister makes major policy announcements, tax changes, reforms. These can hit specific industries hard, positively or negatively. Like that example where higher cigarette duties hit ITC stock price immediately after the budget.
Right. And finally, individual company earnings.
Perhaps the most direct catalyst for a specific stock. Companies must report their earnings every quarter: revenue, expenses, profit, taxes. Sometimes they also give corporate guidance, hints about how they expect to do in the next quarter.
And the market reacts based on whether they beat expectations.
Precisely. It's all about actual results versus the street expectation, what analysts were predicting. Beat expectations, stock usually goes up. Miss expectations, stock usually goes down. Meet expectations exactly. Often the stock does nothing or even drifts slightly lower because there was no positive surprise.
Okay, that makes sense. Now, just to circle back quickly, we talked about IPOs for initial funding. How do listed companies raise more money later on? You mentioned rights issues.
Correct. Rights issues are one way going back to existing shareholders. The other main ways are an offer for sale, OFS, or a follow-on public offer, FPO.
Okay, OFS versus FPO. What is the key difference? This often confuses people.
Yeah, it can be tricky. An OFS is typically used when existing shareholders, usually promoters or large institutions, want to sell a chunk of their shares to the public. Or maybe the company needs to increase the public shareholding to meet regulatory minimums. The key is, it's mainly existing shares changing hands. The company itself doesn't usually get new cash, and the total number of shares doesn't change. It's often done via a separate quick window on the exchange, mainly for larger companies.
Okay, so OFS is mostly existing shareholders selling. What about FPO?
An FPO, a follow-on public offer, is used by the company to raise fresh capital for itself, perhaps for a new project or acquisition. This often involves creating and issuing new shares, so it does dilute existing shareholders and changes the overall share structure.
And it's more like an IPO process.
Exactly. An FPO requires the whole shebang. Merchant bankers, DRHP, SEBI approval, bidding period, just like an IPO, but for a company that's already listed. Our research suggests FPOs aren't used as much these days, maybe because the process is lengthy. Companies often prefer rights issues or even qualified institutional placements, QIPs, if they fit.
Wow, okay. We have covered a ton of ground today, seriously.
Right.
From why we even need to think about investing, fighting that inflation beast, to the nuts and bolts of how markets work, the players, the regulators like SEBI, and those fascinating stories of how companies grow, get funded, and go public via IPOs.
And remember, knowledge is really most valuable when you understand it and then actually apply it. We talk about how vital it is to start forming your own view, your own perspective on the stock or the market. Are you bullish? Are you bearish? And why? Based on analysis, not just gut feel or tips.
So what does this all mean for you listening right now? This journey into understanding stocks, it isn't just about chasing money, is it?
Not at all.
It's about continuous learning, understanding how company specifics connect with those big economic trends, and then strategically choosing the right tools, the right asset class, the right approach, trading or investing that fits your view and your comfort level with risk.
So the question to leave you with is perhaps, how will you use this foundation we've built today? How will you start developing your own informed perspective, manage your investments, and navigate these dynamic markets with a bit more confidence? Always remembering, of course, that learning is ongoing. There's always more to discover, and different perspectives always enrich understanding. Think about that. Blend your personal goals, meeting these powerful market forces we explored.